Something unusual is happening inside China's financial markets. Beijing wants more of this money flowing toward the technologies that could define China's future. Together, China's stock and bond markets represent roughly $28 trillion in capital. And this is where that financial power matters. Building advanced chips requires enormous investment in factories, equipment, research, and years of engineering. Artificial intelligence isn't just a software race anymore. Competing at the frontier requires advanced chips, enormous data centers, electricity, engineers, and billions in long-term investment. Before an advanced chip company can seriously compete, plants, specialized equipment, research, utilities, and production capacity. Beijing's strategy is increasingly about connecting technology companies with public capital, allowing investors to help finance expensive industries that require years of growth. Chinese memory chip maker CXMT raised roughly $8.6 billion through its Shanghai IPO in July. Then came an extraordinary market reaction. CXMT shares surged roughly 466% on their Shanghai trading debut. But CXMT is only one example. China's bigger ambition is to make public markets a stronger funding channel for strategic technology companies. China has also been adjusting its listing system to give strategically important technology companies greater access to domestic public markets. For years, this has been one of America's biggest advantages. Enormous pools of private capital willing to finance expensive technology long before profits arrive. That advantage remains enormous. Recent data shows American private AI investment still dramatically exceeds China's, leaving Beijing with a major financing gap to close. Beijing's potential answer is much larger. Use China's roughly $28 trillion stock and bond markets to channel more capital towards strategic technology. Because AI capital eventually becomes something physical. Computing chips, data center structure, research laboratories, and thousands of highly skilled engineers. But capital alone cannot close the AI gap. China still faces restrictions and technical challenges around access to some of the world's most advanced semiconductor technology. That pressure is also pushing China to invest heavily in its domestic semiconductor ecosystem, from memory and chip manufacturing to equipment and supporting technologies. Because without competitive semiconductors, everything above them becomes harder. From training advanced AI models to operating data centers and building intelligent machines. So China's challenge is much bigger. It is trying to strengthen the entire technology stack beneath it. Takes the capital challenge even further, because intelligence must now be combined with motors, sensors, batteries, factories, and large-scale manufacturing. Chinese robotics companies are also looking toward public markets, turning investor demand for emerging technology into capital for research, factories, and expansion. This is the bigger strategy, not financing one AI champion, but building capital channels across chips, computing, robotics, and advanced manufacturing. The goal isn't proof that China has already caught America. The real question is whether these markets can help Beijing narrow America's enormous AI financing advantage. But here's the crucial catch. $28 trillion is the size of these markets. It is not $28 trillion waiting to be spent on AI. The harder challenge is turning market size into real investment, convincing investors to finance expensive technology companies whose profits may still be years away. And that's the risk. Frontier technology can consume enormous amounts of capital for years, while investors still have no guarantee that every company will succeed. Because this competition is bigger than chatbots, AI leadership increasingly depends on chips, power, data centers, robotics, manufacturing, and the capital connecting them all. This is what makes China's strategy important. Beijing is trying to make its capital markets another engine for financing technological and industrial development. America's advantage isn't only better technology, it also has a powerful financial of pouring enormous private capital into promising companies. But now China is building its own version. If China can turn more of its enormous domestic capital market toward technology, America's financing advantage may become harder to maintain. The biggest beneficiaries could be companies that need enormous upfront investment: chip makers, AI developers, robotics firms, and other strategic technology businesses. For AI companies, deeper financing can mean more computing infrastructure, larger research teams, longer development cycles, and more room to compete before profits arrive. But perhaps more importantly, capital buys time, allowing technology companies to keep researching, training, testing, and improving before their businesses become sustainably profitable. Without enough financing, an AI company can face trouble long before its technology fails. The money can simply run out while research and infrastructure costs keep rising. Access to public markets can provide another source of financing, giving selected technology companies more capital to continue investing and expanding. This matters especially for semiconductors, where expanding production can require enormous spending on fabrication plants, specialized equipment, utilities, and years of engineering. CXMT demonstrates the scale this model can reach. Its Shanghai listing raised roughly $8.66 billion from public investors. The bigger question is whether examples like CXMT become part of a broader pattern, with more strategic technology companies successfully tapping China's public markets. But here's the critical point. Even enormous amounts of capital cannot automatically buy technological leadership. Money still has to become chips, talent, infrastructure, and real innovation. The harder challenge is technological. Advanced semiconductor production depends on extraordinarily complex equipment, manufacturing expertise, supply chains, and years of accumulated. For China's AI industry, advanced computing chips remain one of the most important constraints, because training more capable models ultimately depends on enormous amounts of compute. More capital can help China fund domestic alternatives and expand research, but money cannot erase difficult technological bottlenecks overnight.